When we talk about Richard Wyckoff's approach to stop-loss rules, we're really talking about something far deeper than just a technical tool. At its core, Wyckoff's philosophy around stop-losses wasn't about drawing a line on a chart. It was about survival. It was about preserving your stake in the game long enough to let probability, skill, and discipline compound into results. Too many traders think of stop-losses as something negative, a forced exit, a defeat. But for Wyckoff, the stop-loss was a trader's shield. It was the mechanism that separated professionals from gamblers. The gambler accepts unlimited risk in the hope of unlimited reward. The professional defines their risk so precisely that the game itself becomes sustainable. Think about it this way. The market is bigger than any one individual. No matter how much conviction you have, no matter how perfect your analysis seems, the market doesn't owe you a win. The only power you truly have is over your risk. And the stop-loss is the way you exercise that power. It's the way you declare to yourself, I will not let this one trade destroy me. Wyckoff believed that if you manage to consistently avoid large, devastating losses, profits will eventually take care of themselves. This is why he placed such heavy emphasis on discipline. Without a stop-loss, even the best trade ideas can turn into catastrophic outcomes. With it, even a losing trade becomes just another step in the process. But there's a deeper layer here, and this is where Wyckoff's wisdom really shines. He understood that trading isn't just about charts and numbers, it's about psychology. Most people don't place stop-losses correctly because they're afraid. Afraid of being wrong, afraid of missing out, afraid of admitting that the market has proven them wrong. So they either avoid placing a stop, or worse, they place one and then move it when the market tests it. That isn't discipline. That's denial. And denial has no place in this profession. A properly placed stop-loss isn't just a mechanical tool, it's a commitment to intellectual honesty. It's you saying, this was my thesis. And if the market goes beyond this point, the thesis is invalid. I was wrong, and that's okay. I'll take the small loss and live to trade another day. Wyckoff's stop-loss philosophy teaches us something even more profound. Trading is not about being right, it's about managing being wrong. Think about that. Everyone wants to chase the thrill of the big win, the perfect prediction. But the reality is, no trader, no matter how brilliant, is right all the time. What separates the winners from the losers is not accuracy, but survival. And survival depends on cutting losses before they metastasize into something fatal. If you protect your capital with unwavering discipline, then probability, skill, and the law of large numbers will work in your favor. I want you to imagine two traders. One risks a huge portion of their capital every time, convinced they can't be wrong. The other risks just a small portion, always ready to accept the market's verdict. The first trader might enjoy short bursts of euphoria, but eventually one bad trade will wipe them out. The second trader may endure many small scratches, but because they never risk annihilation, they're still standing when opportunity truly appears. Wyckoff always aligned himself with the second trader. He wasn't looking for quick glory. He was playing the long game, where consistency beats intensity and discipline outlasts ego. This is why I always say, a stop-loss is not a sign of weakness, it's a declaration of strength. It's the recognition that you cannot control the market, but you can always control yourself. And in trading, self-control is the ultimate edge. So the next time you're about to place a trade, I want you to pause and ask yourself, where is the point that proves me wrong? And if the market gets there, do I have the courage to honor it? Because that simple act, placing and respecting a stop-loss, might be the single greatest determinant of your long-term success. At the end of the day, Wyckoff's rule was simple: protect your capital at all costs. Because capital is opportunity. Without it, you're out of the game. With it, even after setbacks, you still have the chance to recover, to learn, to grow. And that's the takeaway I want to leave you with. Stop losses are not about avoiding losses. They're about protecting your future. Respect them, and you give yourself the chance to endure long enough for the market to reward your discipline. Ignore them, and you surrender your future to chance. The choice, as always, is yours. Now that we've laid the foundation for why Wyckoff was so insistent on using stop losses, let's move deeper into the practical side. Where to place them? Because a stop loss only works if it's positioned intelligently. Place it in the wrong spot, and you either get shaken out too early or you expose yourself to unnecessary risk. Wyckoff was very clear on this. Stop loss placement must flow directly from market structure. In other words, you don't pick an arbitrary number of points or dollars away from your entry. You don't place it where it feels safe. You place it where the market itself tells you that your idea is no longer valid. To understand this, we need to step into Wyckoff's framework of market phases: accumulation, markup, distribution, and markdown. Each phase has its own rhythm, its own footprints left by supply and demand, and each phase gives you logical levels where the market will either confirm or invalidate your thesis. For example, during an accumulation phase, Wyckoff often watched for a spring, that sudden dip below support designed to shake out weak hands before the real move upward begins. If you're buying in anticipation of that markup phase, where should your stop go? Not at some random dollar figure below your entry. It goes below the spring low, because if the market falls back below that level, it tells you the spring has failed, and your idea is wrong. That's clarity, not emotion. On the flip side, in a distribution phase, you may see an upthrust, a sharp move above resistance to lure in breakout buyers before the market reverses. If you're positioning short, your stop belongs above that upthrust high, because if the market climbs above it again, then the supposed distribution is not unfolding the way Wyckoff described. Again, the market has proven you wrong, and the stop loss ensures that the mistake costs you little. This is what separates professional placement from amateur placement. The amateur chooses stops based on convenience. I'll risk 50 points because that feels manageable, without asking if that level actually makes sense on the chart. The professional aligns the stop with the natural turning points of supply and demand. That's why Wyckoff always emphasized context. Context over randomness. A stop loss is not just a line. It's a reflection of your entire trade thesis. If the market passes that line, the story you believed in no longer holds. And here's another layer of wisdom that Wyckoff gives us: the idea that the market itself is designed to test your conviction. How many times have you been stopped out only to watch the price move in the direction you originally expected? That happens because most traders place their stops too close to obvious levels, where the crowd clusters. The professionals know this. They drive price just far enough to trigger those clustered stops before reversing. Wyckoff's solution? Place your stop where only a true invalidation exists, not where the crowd is hiding, but where your thesis genuinely fails. That way, if you're wrong, you're out quickly. But if you're right, you give the trade the breathing room it needs to work. This requires humility, of course, because it means you must size your position according to the distance of the stop. If the logical stop is far away, you trade smaller. If it's closer, you can trade larger. But you never compromise by moving the stop to a place that doesn't align with structure. That's just another way of saying you're letting comfort dictate your decisions instead of logic. What I want you to internalize here is that correct stop placement is not about avoiding discomfort. It's about aligning yourself with truth. And the truth is always on the chart. It's in the swing lows, the swing highs, the springs, and the upthrusts. It's in the phases of accumulation and distribution. That's where Wyckoff wanted your focus, not on arbitrary figures or emotional impulses. So the next time you enter a trade, don't ask yourself, what's a safe stop for me? Ask yourself, where does the market prove my idea invalid? Those are two very different questions. The first leads to frustration and whipsaws. The second leads to professionalism and discipline, and that's really the essence of Wyckoff's teaching on placement. Stop losses are not about comfort, they're about clarity. Place them where the chart tells you, and you stop being a victim of noise. You become aligned with the actual rhythm of supply and demand. When you trade this way, the stop loss transforms from something that feels restrictive into something liberating, because it gives you certainty. You know the exact point where you're wrong, and that frees you from doubt. That's the power of correct placement. So remember this: every stop loss is a statement. Either it's a statement of fear, placed randomly to ease your nerves, or it's a statement of discipline, placed precisely where your idea ceases to be true. Wyckoff wanted you to choose the latter, because only then are you trading with the market, not against it.